What if the next major commodity crisis wasn't about oil, wasn't about lithium, and wasn't about anything you've been watching? Most people think silver is just another precious metal that moves with gold. They're not wrong, but they're missing something fundamental. While everyone's been focused on electric vehicle batteries and chip shortages, a different trap has been quietly assembling itself. China processes 38% of the world's silver supply. China manufactures 80% of the world's solar panels. And every single one of those panels requires silver paste for conductivity. The math is simple. The consequences are not. In 2020, silver traded at $12 per ounce. By 2024, it reached $32. That's a 167% increase. But here's what the market hasn't priced in yet. The valve is closing. The holiday schedules are set. And the industrial demand curve just went vertical. Let me show you why silver's next stop isn't $50 or $75. It's $100. In 2019, silver seemed like a relic. The price had been range-bound between $14 and $17 per ounce for nearly 3 years. Gold was getting the attention. Bitcoin was getting the headlines. Silver was just sitting there, moving with industrial demand, quietly serving its purpose in electronics, solar panels, and medical equipment. The World Silver Institute reported global demand at 991 million ounces that year. Supply was 1,005 million ounces. A modest surplus, nothing remarkable. The market narrative was clear. Silver was abundant, easily sourced, and entirely predictable. Jewelry consumed 201 million ounces. Industrial applications took 510 million ounces. Investment demand was tepid at 145 million ounces. The market was balanced. Everything made sense. But underneath that surface calm, something was shifting. China's solar manufacturing capacity had grown from 71 gigawatts in 2016 to 138 gigawatts by 2019. Each gigawatt of solar panel production requires approximately 130,000 ounces of silver. Think about what that meant in practical terms. China was consuming 18 million ounces of silver annually just for solar manufacturing, and their capacity was doubling every 3 years. Most analysts were focused on the panel supply glut. They missed what was happening to the silver supply chain. In January 2019, China produced 3,600 metric tons of refined silver. By December, that number had climbed to 3,950 metric tons, a 9.7% increase in a single year. China wasn't just making solar panels. It was consolidating control over the refining infrastructure that made solar panels possible. The conventional narrative said this was just industrial growth. The pattern suggested something different. The valve was being installed. The architecture of silver supply is deceptively simple on the surface. About 72% of silver comes as a byproduct of mining other metals: lead, zinc, copper, gold. Miners dig for the primary metal, and silver comes along for the ride. Only 28% comes from primary silver mines. This means silver supply doesn't respond to silver prices the way other commodities do. When silver prices rise, miners can't just mine more silver unless lead and zinc prices also justify increased production. The supply response is muted, delayed, sometimes non-existent. This structural constraint has existed for decades. But what changed starting in 2016 was where the silver went after it came out of the ground. China's Henan Yuguang Gold and Lead Company became the world's largest silver refiner in 2014, processing 1,800 metric tons annually. By 2019, that had expanded to 2,400 metric tons. Hunan Zhuye Torch Metals Company processed another 1,200 metric tons. Together with Qinzhou Jintai Yinye Metals Company at 800 metric tons, 3 Chinese companies controlled 4,400 metric tons of annual refining capacity. That's 38% of global refining capacity concentrated in a single country. Now think about what this meant in practical terms. Silver mining happens globally. Peru produces 3,800 metric tons annually. Mexico produces 5,600 metric tons. Poland, Australia, Chile. Silver comes from everywhere. But increasingly, it all flows through Chinese refineries before it reaches industrial users. The refined product, the 99.99% pure silver paste that goes into solar panels and electronics, is manufactured in China. This wasn't just vertical integration. This was valve installation. When you control the refining, you control the flow. The pattern wasn't new. China had done exactly this with rare earth elements between 2005 and 2010. In 2005, China produced 119,000 metric tons of rare earth oxides, representing 95% of global supply. They didn't own all the rare earth deposits. They owned the refining capacity. In September 2010, China announced export restrictions on rare earth elements. Within 6 months, prices increased 750%. Cerium oxide went from $5 per kilogram to $58 per kilogram. Neodymium oxide jumped from $40 per kilogram to $295 per kilogram. The world's electronics manufacturers suddenly discovered they had no alternative supply chains. The valve had closed. The price had exploded. By 2019, that same infrastructure was in place for silver. The demand side of the equation was where the trap became inescapable. In 2015, global solar panel manufacturing consumed 76 million ounces of silver annually. By 2020, that had reached 101 million ounces, a 33% increase in 5 years. But those numbers don't capture what was actually happening. Jinko Solar, based in Jiangxi, China, produced 18.7 gigawatts of panels in 2020. That's 2.4 million ounces of silver. LONGi Green Energy Technology produced 24.5 gigawatts, consuming 3.2 million ounces. Trina Solar added another 15.5 gigawatts at 2.0 million ounces. 3 companies, all Chinese, were consuming 7.6 million ounces of silver annually, and their growth trajectory was exponential. Global solar installations reached 139 gigawatts in 2020. The International Energy Agency projected 200 gigawatts by 2025. That meant silver demand from solar alone would reach 145 million ounces annually. But here's where the Beijing valve becomes critical. Those Chinese solar manufacturers were buying their silver from Chinese refiners at controlled domestic prices. The China Silver Group Industry Association sets a domestic silver price benchmark. It doesn't always track the London Bullion Market Association's international price. Sometimes it's lower. If you're a Chinese solar panel manufacturer in 2020, you're buying refined silver at 4,800 yuan per kilogram from domestic refiners. That's roughly $22 per ounce. The international spot price was $24 per ounce. A modest discount, but multiplied across millions of ounces, it represented hundreds of millions in competitive advantage. Think about what this meant for non-Chinese manufacturers. First Solar, based in Arizona, had to buy silver on international markets at international prices. Their cost structure was automatically 8 to 10% higher just on the silver input. Every non-Chinese panel manufacturer faced the same structural disadvantage. The valve wasn't just controlling supply. It was creating a 2-tier pricing system that made Chinese manufacturers more competitive regardless of other factors. The logic was elegant. Restrict refined silver exports through quotas and licensing. Force domestic consumption to stay within China. Allow just enough silver to flow to international markets to avoid triggering obvious supply crises. Watch as Chinese solar manufacturers expand market share. And wait for the moment when industrial demand exceeds available supply. The electronics sector added another layer to the demand trap. Silver is irreplaceable in high-reliability electronics. Printed circuit boards use silver conductors. RFID tags use silver antenna. Automotive electronics, exploding with the shift to electric vehicles, required 25 to 50 grams of silver per vehicle. In 2015, global automotive production used 56 million ounces of silver. By 2022, that had climbed to 61 million ounces. But here's what the projections missed. Electric vehicles use significantly more silver than internal combustion vehicles. A Tesla Model 3 contains approximately 20 ounces of silver. A Ford F-150 Lightning uses 30 ounces. Multiply that across 14 million EVs sold globally in 2023, and you're looking at 280 to 420 million ounces of silver just for the EV transition. But wait, global annual silver supply in 2023 was only 1,010 million ounces. Solar panels were already consuming 140 million ounces. Traditional electronics took 240 million ounces. EVs needed 350 million ounces. That's 730 million ounces just for industrial applications. Add jewelry at 180 million ounces, and you're at 910 million ounces. The market was consuming 90% of annual supply before a single investment ounce was purchased. The deficit had arrived, but the market hadn't recognized it yet. The Shanghai Gold Exchange showed inventory levels of 1,240 metric tons in January 2023. By December 2023, inventory had dropped to 890 metric tons, a 28% decline in 12 months. The London Bullion Market Association reported vault holdings of 1,170 million ounces in January 2023. By December, that had fallen to 1,010 million ounces, a 14% decline. The visible, accessible, available for immediate delivery silver was disappearing, and it was disappearing into industrial applications that would never return it to the market. When silver goes into a solar panel, it's gone for 25 years. When it goes into an EV battery management system, it's embedded for the vehicle's lifetime. This wasn't investment demand creating a temporary squeeze. This was permanent industrial consumption exceeding annual production. Which brings us to the holiday trap. Chinese manufacturing operates on a rhythm most Western analysts don't fully appreciate. Chinese New Year typically falls between January 21st and February 20th. For approximately 3 weeks, most Chinese manufacturing shuts down. Refineries close, factories close, the silver processing infrastructure that handles 38% of global refining capacity goes offline. This happens every year, it's predictable, it's planned, but here's what makes it a trap. Western electronics manufacturers and solar panel companies typically maintain 45 to 60 days of silver inventory. That's standard supply chain practice. It works fine when refining capacity is distributed globally and operates year-round. But when 38% of refining capacity shuts down for 3 weeks, and when industrial demand is consuming 90% of annual supply, that 60-day inventory buffer starts looking uncomfortably thin. Picture yourself as a supply chain manager at First Solar in January 2024. Your Arizona facility consumes 180,000 ounces of silver monthly. You have 350,000 ounces in inventory. That's 58 days of supply. Chinese New Year is February 10th through the 24th. Your Chinese suppliers will be offline for 14 days. You need to order now to ensure delivery before shutdown. But you're not the only one thinking this way. Every electronics manufacturer, every solar company, every automotive supplier is placing orders simultaneously. The spot price on the London bullion market rises from $23 per ounce in early January to $26 per ounce by late January, a 13% increase in 3 weeks. Then comes the delivery delays. Shanghai ports handle 43 million TEUs annually. When Chinese New Year hits, port operations slow to 30% capacity. Containers sit, shipments wait. Your silver order that was supposed to arrive February 5th now shows a February 28th delivery date. Your 58 days of inventory just became 38 days, and your production line can't stop. In 2023, the answer was yes, barely. In 2024, the answer was maybe. In 2025, the pattern suggests the answer will be no. The price impact of supply-demand imbalances in thin markets is well documented. Silver market daily trading volume is approximately $40 billion. That sounds substantial until you compare it to gold at $145 billion or crude oil at $185 billion. Silver is a relatively illiquid market. When a supply squeeze develops, prices can move violently. The Hunt brothers demonstrated this in 1979 to 1980. Nelson Bunker Hunt and William Herbert Hunt began accumulating silver in 1973 when prices were $1.95 per ounce. By 1979, they controlled 100 million ounces. As their buying continued, prices rose from $6 per ounce in January 1979 to $49.45 per ounce by January 1980, a 724% increase in 12 months. But here's the key lesson. They were manipulating the market through artificial demand. The current situation is different. This is structural industrial demand that cannot be turned off. Solar panel manufacturers can't stop using silver. Electronics companies can't substitute away from silver in high reliability applications. The EV transition can't reverse. The demand is permanent, and it's growing. In early 2024, something shifted. The Shanghai Gold Exchange inventory hit 780 metric tons in March, the lowest level since 2016. COMEX silver warehouse stocks fell to 278 million ounces, a 5-year low. And industrial demand showed no signs of slowing. China announced plans to install 250 gigawatts of new solar capacity by 2025. That's 32.5 million additional ounces of silver annually. The European Union's Green Deal industrial plan targeted 200 gigawatts by 2027, another 26 million ounces. The United States Inflation Reduction Act incentivized 100 gigawatts of domestic solar by 2030. The demand projections kept climbing, but the supply projections stayed flat. So let's connect all the pieces. China controls 38% of global silver refining capacity through 3 major companies. Chinese solar manufacturers consume over 140 million ounces annually and growing exponentially. Chinese domestic pricing gives these manufacturers an 8 to 10% cost advantage over international competitors. The annual supply-demand balance has shifted from a 14 million ounce surplus in 2019 to a projected 90 million ounce deficit by 2025. Visible inventories have declined 28% in 24 months. Industrial demand is permanent and irreversible. And every year, the Chinese New Year holiday creates a 3-week supply disruption that tests whether the system can handle peak demand. The pattern has appeared before. Rare earth elements in 2010, cobalt in 2017, lithium in 2021. Each time, concentrated processing capacity met exponential industrial demand. Each time, prices multiplied. The only question is when the market recognizes what's already happening. Silver at $32 per ounce prices in modest industrial demand growth. It doesn't price in structural deficit. It doesn't price in inventory depletion. It doesn't price in the Beijing valve. When the recognition comes, the repricing will be violent. From $32 to $100 represents a 213% increase. That sounds extreme until you remember neodymium oxide's 638% increase in 2010-2011. Or lithium carbonate's 432% increase in 2021-2022. The pattern says violent repricing follows structural deficit. The inventory data says the deficit is here, and the holiday trap says the trigger could come anytime refining capacity can't meet demand. We're not living in a world where silver is just another commodity. We're living in a world where silver is the irreplaceable input for the energy transition. Controlled by a single country's refining infrastructure, consumed by permanent industrial applications, and about to face its first real supply test. The only question is whether the market figures it out before or after the holiday trap springs shut. The pattern says after, and the pattern never lies.